Hi everyone. All right, the third method we're looking at is the aging analysis. The aging analysis looks at the age of the receivables. So it is a balance sheet method, right? So if you remember that chart with all the flow chart there, this is a balance sheet method. It's the second balance sheet method. So the aging of accounts receivable looks at how old are your receivables, because the older they are, the less likely you're going to get paid, right? If somebody hasn't paid you for months, it's probably a pretty good chance you're not going to get paid. So the idea is that the older they are, you put them in buckets, and the older they are, you say, I think it's a 90% chance I'm not going to get paid on those. And maybe it's only a 1% chance I'm not going to get paid on the ones that are new receivables. Okay, so here, let's look at this. This is an aging analysis. The idea is like I said, you're putting them in buckets. For the ones that, the receivables that you've sent out that are only current receivables, meaning you've just sent them out, they've only been out for less than 30 days, you've got these three balances. The total receivables in this bucket are 4245. You're assuming 1% of those people are not going to pay you. Ones that are more than a month old, but less than 2, you're assuming 2% of those people aren't going to pay you, because you're starting to go, why aren't they paid me yet? It's been almost 2 months now. So the percentage, the likelihood of not getting paid is going up. Then you go, okay, well now these people haven't paid me for more than 2 months. Less than 3, but more than 2 months, so it's old. Right? So now we're looking at 3%. And we're saying anybody who hasn't paid us in over 90 days, over 3 months, there's a problem. And we're probably not going to get paid. There's a 90% chance I'm not getting paid by these people. Okay? How you come up with those percentages is just your experience as the accountant over time. There's no rules on that. You just have to be consistent. Okay, so we multiply these down and we come up with a total. And that $185, when you add them all across, is going to be what you want to be your target balance, right? So remember, with these guys, you had to take into account what the current balance is in the account before you come up to the 185. The 185 is the number I want my allowance for bad debts to be. Okay, so, oops, there goes my total receivables. So that's my allowance for bad debt amount that I want it to be. Okay, so now here's the the example. It says that 185 is the right amount. Assume that the allowance for bad debts currently shows a $20 credit balance. Let's put that $20 credit balance in there. I want the number to be 185. So how I get there? I do that credit for 165. Allowance for bad debts, 165. There you go. And bad debt expense for 165. Right? Remember, with these balance sheet methods ones, we have to care about what's in there already, what's in that allowance account, and adjust for it. What if it had a $20 debit balance? Well, let's put that in there. And we want the total to be 185. So how do we get there? Well, we need a credit for 205. There you go. Because we had 20, we want it to be 185, so we've got a credit for 205. So now 205 minus 20, there's your 185. And bad debt expense for 205. Okay, so this is a try it. You would multiply all of these guys across. I only have the total here. If you add them all together, you'd be at 6288, right? Multiply them across. I, for whatever reason, didn't put the totals, individual ones across here. But the idea is these are buckets. We're just looking at them from a different angle. We're looking at them horizontally. So we want it to be 6288. There's a 210 debit balance in there right now. Right here, 210. I want it to be 6288 though. So my credit for my allowance for bad debts has to be 6498 for it to work. All right. Oh, okay. So that's it for that part. What happens, right? Go back to the original journal entries for the write-offs. What happens when people default, right? These three people are going to default. We decided we're going to write off their receivables. So we're going to start using up that cushion at 6498. So pretend this is our accounts receivable right now, just to make it a little easier to look at. We are going to credit each one of these because we're taking them off the books. We're assuming we're not getting paid. And we're going to debit the allowance for bad debts. We start using up that cushion with that debit. Oops. And that's where you'd stop. Okay? You've used up your cushion. You've reduced the receivables. All right. However, what if this person, Kyle, wound up paying us? And we didn't expect that. So check came in the mail later. If that was the case, remember those two steps. We have to reverse the original write-off, right? So we're going to debit accounts receivable and credit allowance for bad debts as if it never happened. And then we would just record the money Kyle sent us. debit cash, credit receivables. That's it for that. It asks a question though that I want to talk about. What circumstances would cause the allowance for bad doubtful accounts, allowance for bad debt, same thing, allowance for uncollectible accounts, same thing, to have a debit balance prior to adjustment? Well, you could wind up with, you could wind up with a debit balance in here, right? Because remember, it carries a credit balance normally. But you could wind up with a debit balance at year end because more people could default than you expected them to. So what I mean by that is when you're debiting this, you're using it up. That is the write-offs as people start to default. What if you estimated too low, right? Because that original estimate at year end, December 31st, is just that. It's an estimate. And you put that in there. Let's say you estimated, what did we estimate in the last problem? 6288. You estimated 6288, but you had more write-offs than 6288. You could wind up with a debit balance in that account. It happens, write-offs being greater than the estimates, especially these days. All right, Lord knows what's going to happen with these companies right now. Okay, let's start talking about notes. Okay, shift gears. We're kind of done talking about receivables. All right, notes receivable looks very much like a check. I mean, most of the time these things are electronic these days, but I mean, the pieces are there. And the idea is you have signature, it looks like a check, but there's a couple of extra pieces. You have a period of time that you expect to be paid with a note. You have an interest rate associated with it. The idea with a note is that it's a more formal document than an account receivable. Accounts receivables just come from a regular back and forth business. Notes receivable is more formal. There's agreements, there's signatures, there's interest rates associated with them. They're usually for a longer period of time. It could be a loan for money. It could be maybe you sold a product to somebody, but they can't pay you in the 30 days you normally get. So you say, okay, pay me in 6 months, but you're going to pay me interest too. That's a note. All right, so, oops, there we go. Let's talk about how you calculate that interest on those notes. Well, the interest formula is the same no matter what class you're in, no matter anything. The interest is always calculated as principal times rate times time, and the rate is the interest rate. So if you look at it, that note that we just had there, sorry, I should grab it, $2,000, 90 days, and it's 10%. Okay, so let's go back. $2,000 is principal. The interest rate was 10%. Interest is always stated as an annual number, meaning interest is for an entire year. But we're not borrowing for an entire year. We're borrowing for 90 days. So if that's the case, that time component gives you that prorated piece for 90 days. So that time is how much of a year is it. So in this case, it's 90 over 365. That's how much of the year it is. If it was for one full year, it would just be times 1. If it's for 6 months, it'd be, 6/12 or half. You get the idea? And that calculates as $49. Now, if they ask you what's the maturity value, well, the maturity value is how much is the full amount of the note. Not just the $2,000 you borrowed, that's the principal, right? The interest, the maturity value is the principal and the interest together. What is the full amount you're going to get paid? In this case, it's $2,049. Okay, so just to get you comfortable with that the terminology a little bit. All right, so I have you doing a try it. I'll pause, try these, and then we'll come back. All right, so interest, maturity value, interest, maturity value. Hopefully you got there. Okay. I think I might pause us and go on to one more video just so I don't have to scrunch this at the end.